What's going on, everybody? It's Jay Fielder with Mind Growth, and we're going to break down some technicals in the stock market, Bitcoin, Ethereum, and other macro factors. Let's go. All right, this is S&P 500, basically an ETF that tracks the stock market. So if you're interested in, what the stock market's doing, you just pretty much got to look at the SPY. It's on Robinhood. It's SPY. You can find it pretty much anywhere else that has a brokerage account or shows charts. All right, so let's get into this first. Let's get some context to where we're at. So from January, when the Fed announced that they'd be tightening rates from inflation, we drew down a total of 24%. A bear market technically is 20%, anything over 20%. So we did get in bear market territory. And since then, we've had a nasty run up. And some people think, hey, this is just a bear market rally. Others think, hey, we're going to be supporting it. Let's just look at some objective evidence on kind of where we're at. So 19% is where we're running up to. We ran up about 19%, and we have a lot of resistances here. First, probably the most important resistance is the trend, the entire trend that started in January. And I call this the big picture bear market trend because that's when the trend started, is basically when we first started selling off. And you can see we ran into this trend and easily got rejected. I call it the triple resistance because, let me turn on this SMA. We also got rejected by the 200 moving average. And that's just the last 200 days of, this is where the average price is for the last 200 days. So we got rejected at the trend. We got rejected at the 200 moving average. We were also overbought on RSI. RSI is buying pressure. Once you get above about 70, right outside of this zone, you're going to be in overbought territory, and usually a lot of sellers come in, start selling. As you can see, when it's oversold, usually we get a little bounce to some extent, okay? So overbought, bear market support trend, 200 moving average, and at the same time, we call these levels. Here, the SPY supported the 430 level. This is the price of 430, supported here, kind of got rejected, played around, rejected, came above it. And then it fell right below, then it got rejected again. So this has shown it's a clear level to recognize, 430. So again, 430 level rejected. This is all in zone 1, by the way. Zone 1 is, this is a resistance. Resistance is going to be in zone 1 as we speak. And so far we have a lot of resistance in zone 1, the 200 moving average, the bear market support trend, the 430 level, and at the same time, we were in overbought territory. So now, let's take a look at where we could be moving. We're in zone 2 as we speak right now. And the first thing I want to look at in zone 2 is, were there any previous signs of support that we could look at possibly, bouncing on? And we do know earlier in the rally, we pulled above the 50 moving average, and then we supported there. So that's going to be some support we look at. Right now it's sitting at 395, but we also supported the 100-day moving average. So that'd be the first line of support that I would think, hey, we might take a bounce here. If it fails, we're probably coming down to the 50 moving average, all in zone 2. Either way, we should be in zone 2 unless we should stay in zone 2. We'll probably bounce somewhere around zone 2, retest this 415 level to see if we can get back in zone 1. Now, what would get us back in zone 1? Probably the Fed being a little more dovish. Housing data, recession data coming out, not looking too bad, not slipping too far. That's what the market's kind of looking at. Hey, are we in a recession? Yeah, we're in a recession, but can we bounce in zone 2? Can we hold in zone 2? Is the Fed going to tighten rates faster than we expect or not? And the stock market's always looking at expectations. So if it expects something, it's going to bounce somewhere. But if something comes out and surprises the stock market and it did not expect it, we could, we'll probably come down, test 390, the top of zone 3. And if the data comes out super ugly, or the Fed comes out and says, hey, we're going to increase rates by 75 basis points instead of 50, or, does something surprising, we're going to see us crack to zone 3. Now, another thing to look at is keep an eye on, this is the daily chart, keep an eye on the RSI. So as the closer the RSI comes to the bottom, the better the probability that we're going to see a bounce somewhere. You don't want to be buying at the top of the RSI. or expecting a bigger move, even though it can happen, but we'd need to be breaking out of the big picture bear market trend. So we're not doing that yet. So I would wait till we get lower in here, and that tells us, okay, the stock market has some room to drop. So I'm looking at somewhere between 407, 408, and 395. I think we bounce at the 50 EMA. That's my guess if I had to guess. All right, now let's take a look at Bitcoin. All right, so Bitcoin also got rejected in zone 1 between 23K, 25K. Could not get above there. Looks like we're in a bear market rally also. So for Bitcoin, it's below all these simple moving averages. So we could just call the next resistance somewhere around 23K. Let's go ahead and take these off. We don't really need them. So we can use trends for Bitcoin. It moves a lot faster than the stock market. It's not as big. So we'll be using exponential moving average. So it looks like we're kind of holding this trend. And if we do roll over from here, I'd expect us to go to the next support, right? So we could move right out of here. We should know in the next couple of days, or at least this week, if we're going to keep moving in this trend or in this channel. If we break this channel, we go to the next support line. Next support is probably going to be somewhere between 20,000, 19,000. I think it's around 19,000. And if we cannot hold 19,000, we're going to drop, probably make some new lows into 16,000. I have this drawn from just earlier in the year. Well, 2020, way back in 2020. So those are the zones for Bitcoin. Now, if we look at the RSI, we kind of bounce, but it looks like it's going to turn lower a little bit. I still think it's a good buy zone if you're looking for the long term, next 3 to 6 months, next 18 months. This is going to be an amazing buy. But if you really want to get bullish, or if you're holding Bitcoin, I wouldn't get too excited unless we regain support on this 50-day moving average. The 100 moving average is going to be in green. The 200 is way up here. We're not even close to the 200 moving average. But at least we should see a bounce in the RSI, get above the 50. Not just get above it, but we want to support it too. We want to see price come back, check the 50-day SMA, and then go test the 100-day SMA. And then if we stay in this channel, there's always a chance that we break. This is actually a bearish channel. So if it's moving upwards, there's more probability it breaks back down to the downside. We want to see a descending channel for a breakout, and we're not seeing that. A descending channel, real quick, is going to look a lot more like this. We're falling. This is pretty much a falling wedge. These are a lot more powerful. You see a big explosion on the RSI, and there's a lot more momentum whenever you're in a falling wedge or a falling channel. So right now we're in an upwards channel. We're climbing, which is not very bullish. But hey, for the short term, if you're investing and you're not trading it, still good. It's still a good level to buy. Under 25K is always a good level to buy. So look at zone 2. Are we going to hold support? Are we going to retest the top of zone 2, or are we going to test the bottom of zone 2? That's kind of what we're looking at right now. Probably the biggest factors are going to be similar to the stock market. How much liquidity is going to be taken out of the stock market? How much liquidity is going to be taken from crypto as the Fed tightens interest rates and as they reduce the money supply? All right, so let's take a look at Ethereum. Where are we coming from? We had a big move back in 2020, and we've been consolidating the whole time. Let's check. Let's see, from the highs, Ethereum sold off 80%. Okay, that would have been a good buy down there, 80%. And now it's up. Let's see, well, right now it's up about 74%, but it ran up 100+%. And I kind of did this back in the last rally, last bear market rally. So I wouldn't get too excited about this. It's still, it's a rising channel. But to zoom in a little more, Ethereum's actually outperforming Bitcoin. We have it supporting, well, it's kind of supporting the trend, and it's holding this 100-day moving average in zone 2. Does it hold? I don't know. If it breaks, we're obviously coming, we're coming back to the top of, or the bottom of zone 2, top of zone 3, somewhere around 1250. And if it does show strength, we're gonna see us run into zone 1, and we're gonna retest 2000. That's the big level. 2000 is the big level. If we can get past 2000, Ethereum's going to launch from there. And we have the merge coming up in September. So we don't know if we're going to see buying into the merge or we're going to see a sell off. And then when the merge comes out, we see buying start to pick up after that. The merge is big. Look it up if you haven't heard of it. All right, some other macro technicals we want to take a look at are going to be oil futures. Why? Because oil is the main input to inflation. And we want this price to continue lower to keep the inflation. We can't control it, but to see inflation come down, a big factor is going to be oil prices. So far they've been trending lower. And if they do happen to break out and go back to the highs, it's not going to be good for markets. The Fed will have to increase their interest rates. They'll have to hike a little faster or hike a little more. And that's gonna destroy the stock market and crypto. So we're hoping that oil continues lower. Maybe it pops out and retests. So there's a lot of resistance here at 95. If it comes back, it can retest at 95, and then hopefully it rolls over. If it gets above it and you're holding energy or oil stocks or whatever, then you're probably gonna do good. But for the most part, we don't want to see inflation get any hotter. All right, so another thing I want us to look at is why interest rates might be rising. And interest rates respond to growth and inflation. The higher inflation goes, the higher interest rates go. But we're starting to see growth slow a lot. So why would interest rates be moving up, especially if we saw inflation print lower last week, or the last inflation print in the month over month went to 0? So why is it going up? Well, I think it's because of this chart. This is the United States Natural Gas Fund. And although oil prices are dropping, natural gas is probably the second biggest input to energy prices. It bottomed back here in July, and it just ripped through all these simple moving averages: 200, 100, 50-day moving average. It supports a 50-day moving average. And you could look at this as a very bullish pattern. This is a cup and handle. Even though I didn't draw it like a cup and handle, it's basically a cup and handle. And it looks like natural gas prices are starting to break out, and that's not a good sign. If this continues higher, it's going to cause inflation in general to pick up again. So this might be why bonds are rising. If we see it roll over, then you should see bond yields or interest rates start to roll over again. But this might be the real reason. Now, is it as important as oil prices? I don't think so. Oil prices are a much bigger input. So as long as oil stays below 95, I think we're okay. All right, so let's also take a look at the dollar. The dollar is the reason we're seeing such a huge pullback in, Ethereum had a huge pullback. Bitcoin had a huge pullback recently, and the stock market got rejected. And I thought this was going to happen. Why? Because the dollar is the wrecking ball. When it moves fast, it wrecks the other markets. So you can see the dollar has been supporting the 100 100 moving average pretty clear, and also the 50 moving average. It had this bullish wedge pattern, and then it supported the 50 moving average, and then it just exploded. So this kind of move right here is because the dollar is the denominator of all currencies. When you think about it, when you sell Ethereum or you sell Bitcoin or you sell stocks or you sell anything, you're collecting dollars. So the higher the dollar goes as the denominator, the lower the prices of what it buys. And the scary part is if the dollar continues to rise, if it breaks over 109, the next resistance is about 120. So that's a lot of pain right there. I'm not sure markets can survive moving as the dollar moves up that fast. And let's look at a little bit of history of what the dollar does. All right, so this is the dollar against the stock market. The stock market's over here in black, and what I wanted to show you is when the dollar makes big moves, it usually, and this is since the 2008 global financial crisis, the housing crisis. Since that time, as the dollar spikes, the stock market usually pulls back a lot. Especially, these are big time periods, but when it moves a lot, it's going to push down stocks because people are selling. You got to think of the dollar as the reserve currency, as a safe asset. Think about it. If anything you own, you're afraid or you need to sell it because there's some kind of crisis, you're going to sell in dollars. You're not going to hold assets if you need those dollars. So when dollar liquidity goes up, or when the demand for dollars rises, it's usually because investors, hedge funds, institutions are selling. They're selling something. So you have the dollar spiking here, stocks pull back, Got another scenario in 2009, happens again. Dollar spikes, stocks, have a rough time. Happens here. Again here, let's make it a little clear. Dollar runs up a whole lot in this instance, and stocks pretty much traded sideways for a couple of years. And then the very opposite happens when we have the dollar decline for a while. And this is what, December 16th, 2016 till the 18th. You have the dollar decline for 2 years, and stocks pretty much perform pretty good. And then again, right after the 2020 crash, you have the dollar sell off, or the dollar goes lower, probably because of quantitative easing, and you have the stock market run up. So again, if we're going to see the market bottom in crypto or the stock market, we want to see that final capitulation to the top for the dollar also. The dollar is going to play a huge role in actually seeing a bottom or the beginning of a new bull market. So the scary thing is, again, like I said, we could double top here, but the scary thing is the next major resistance is 120. So that's a big move. Does it get there? Who knows? Maybe, maybe not. But either way, what we're looking for is this trend to break, roll over, and begin the next bull market. So keep this in mind. All right, this is the volatility index, and it basically is the insurance against the stock market. When it spikes, people are betting against the stock market, so we don't want to see that. And for a while, since November, it started spiking, and it's been holding this trend, the bear market support trend. It's holding that trend, Now it got below it, people got very bullish, but as of today, this, the VIX just spiked above it. So what does that tell us? Well, it's probably going back to the highs, which is max uncertainty. Where's that uncertainty coming from? Slowing growth, recession. Is inflation back? Maybe, maybe not. I think inflation peaked, but now we're headed for a recession. A lot of companies are laying off jobs, so that's probably why the VIX is starting to spike now. But if we ever get below this trend, consolidate, and then drop even lower, then that'll be a signal, hey, we're headed back into a bull market. There's not, people are not betting against the stock market anymore. And that's also going to affect crypto. So keep an eye on the VIX. So the last thing I want you guys to check out here are interest rates or long-term rates. The Fed funds rate, what they control, that's at the short end. But most of the market uses the treasury bonds or, U.S. treasury bonds as interest rates. So let's take a look at this. So interest rates have been climbing for a while. Down at the bottom of 2020, interest rates got to 0.5%. And now we hit a local high of 3.5%. That is not good. That tightens markets significantly. That's a lot of tightening there. Companies have bigger debts to pay. If they want to borrow, their payments are going to be a lot bigger. So we don't want to see this if we're looking for a return. If we're looking for the return of the bull market. So mortgage rates are a big part of the market. And, if rates are way too high, you're going to get a slowing in housing. You're going to get way too much slowing in housing. People are not going to buy because prices are already too high. And if the interest rates are much higher, then you're going to get a collapse in growth to some extent. So the 10-year treasury bonds, or actually any bonds, you look at just the movement, the percent move is going to tell you if interest rates are rising or not. So for a while, it looked like interest rates were dead. We saw this pattern. It dropped the reverse head and shoulders, and we thought it was going lower. And markets like that, that's when the SPY started spiking a lot because interest rates were lower. It's going to make money cheaper, right? But it recovers, and now it looks pretty bullish. And this is again not a good sign right now. Now, is it going to go back to 3.5? I doubt it, unless we see oil prices start spiking again. But for now, the market is sniffing something out. And as long as it rises, then expect the mortgage rates to stay elevated, and therefore other interest rates, which is a lot of tightening for the market, a lot of down pressure.